So, good afternoon, everyone. Thank you so much for attending this very important webinar. I am Debbie Evans. I'm the Project and Event Coordinator for the Greater Binghamton Chamber of Commerce, and we are just so glad to have you here with us today for this terrific webinar on the employee tax credit and then the American Rescue Plan as well. So we want to give a great big thank you to Dannible and McKee for putting this webinar on for all of us and all of you. Nick Shires is presenting today. Nick is the partner in charge of tax service at Dannible and McKee. They're a certified public accounting and consulting firm with offices in Endicott, Syracuse, and Schenectady. Nick is a certified public accountant with over 16 years of experience providing tax and consulting services to a wide range of clients. He specializes in all areas of corporate and individual income tax compliance with focused expertise in the area of tax credits and incentives. Nick is also a recent graduate of the Leadership Greater Syracuse and a member of the 40 Under 40 class of 2020. What we'd like to do today, Nick is going to make this a very interactive presentation. So if you could please place your questions in the chat, and then throughout his presentation, I will read those questions for Nick. So without further ado, we are going to get started. And Nick, I am going to turn this over to you. Thank you.
Great. Thank you, Debbie. That's quite the intro. I appreciate it. And I appreciate the Chamber allowing me the opportunity to speak with all of you today on some very timely and important topics that I think can bring some significant benefit to businesses in the area, and especially employers with employees that you've kept on staff. We've got some significant tax benefits that are now available as a result of the act passed in December, and as a result of the most recently passed stimulus bill that was passed here in the last couple of weeks. So I want to make sure we get to all the information, so we'll get right into it. I'm going to focus today on the employee retention credit. We'll talk about a little bit of some of the other items in the American Rescue Plan, but the main focus is going to be the employee retention credit. That's the one that seems to be the most wide sweeping. It applies to most employers, and will be the one that provides the biggest benefit. So we're gonna focus most of our time on that today. And like Debbie mentioned, if you've got questions throughout, I'll pause a little bit, and I want to make sure we get questions answered. There's a lot of we'll call it gray area in some of the way that some of these rules can be interpreted. So you may find that a lot of what I'm going to talk about today applies in specific situations. So we want to make sure we get your questions answered here today. And if we can't answer it right away, we'll certainly follow up. And if we don't have time, we'll follow up with you guys after. So the first step we got to do is take a look at kind of the timeline and how the employee retention credit came into play, and how it works, and kind of the history of, what we're looking at. So back in March of last year, so almost a full year ago, it was included in the CARES Act. So the CARES Act was the first stimulus bill that was passed when the pandemic first hit last March. We saw that had the PPP loan program, the Paycheck Protection Program. It also included this employee retention credit, but at that time in March, the CARES Act included some restrictions that made the impact and the benefit of the employee retention credit fairly limited. The main restriction was the fact that you could not utilize both the Paycheck Protection Program loan and the employee retention credit. So we'll see that changed. So we didn't have too many that really qualified for the employee retention credit in 2020 when it was first introduced in the CARES Act in March. After the CARES Act came out, the IRS released their interpretation, their frequently asked questions on the IRS website. They've since, in the last 2 weeks, formalized these frequently asked questions because they were not authoritative before. They were just kind of their interpretation. They've now since formalized those in an IRS notice 2021-20. And we got some further clarification on some of the updates too, in addition to having these rules kind of spelled out and how the IRS is going to interpret them. Then in December, we had an extension and an enhancement of the employee retention credit and the second stimulus package that passed late in December of 2020. What this did is it increased the availability of the 2020 credit. So the credit that was available under the CARES Act, it increased the availability of that. So it allowed those that took a PPP loan can now utilize the employee retention credit in connection and in addition to receiving forgiveness under the Paycheck Protection Program. So really a good benefit to those, and we can now take a look and maybe potentially go back and recoup some of the credits that are now newly available in 2020 as a result of the law passed in December. And in addition, the law in December extended the availability of the credit for the first 2 quarters of 2021. So now, in addition to being available from March 12th to 2020 through the end of 2020, we've got the first 2 quarters. And then in last week, with the third stimulus package, the employee retention credit is now extended, and there are some slight modifications as well for the third and the fourth quarters of 2021. So now we have this credit that I'll be walking through some of the details about. We have this credit available through the end of 2021. So all 4 quarters could potentially qualify. So there's some significant benefit that we can see through the end of this year. So the first question we got to answer is, how much is the credit? So the credit is different. Different rules apply for the credit in 2020 than apply for the 2021 credit. And we'll see even after with the passing of the American Rescue Plan, there's different rules for the first 6 months of 2021. There's some additional rules that apply for the third and the fourth quarters of 2021. So the credit for 2020 is a credit of up to 50% of qualified wages. And that maxes out at $10,000 of qualified wages per employee. So a maximum credit for each employee of $5,000. And that's for the entire period, March 12th through December 31st. And we'll see what qualified wages means as we get into this presentation a little further. But a pretty substantial credit if you qualify in 2020, $5,000 per employee. And we're finding that can be pretty substantial. I've got a few clients with 50 employees up to 85 employees where the credit based on a $5,000 per employee is a few $100,000. So pretty substantial credit that's available to go back into 2020 and claim. The credit for 2021 is, as I mentioned, enhanced. So the credit there is 70% of qualified wages. Same maximum wages, $10,000. So a credit of $7,000 per employee. However, rather than that $7,000 limit applying to the entire year, it applies on a per quarter basis. So you could have $7,000 credit per employee per quarter, which if you're eligible in every quarter, we'll talk about the eligibility rules, but if you're eligible in every quarter, that could be up to $28,000 per employee as a refundable credit. So really quite substantial, the amount of the benefit that can be realized for those that are going to be in the bucket here that qualify for the employee retention credit. So we got to next determine, we know the amount of the credit, we know that there's a pretty substantial benefit hanging out there. How do we determine who gets to claim the credit and how do we calculate that credit? So for 2020, an employer that either experienced a full or partial shutdown of their operation as a result of a government order, we'll get into some examples on that. So if you meet that during any period of time where you have a partial or full shutdown of your operation, you are an eligible employer during that period. Or, so you can have that either or and a period of significant decline in gross receipts. And for the 2020, the significant decline in gross receipts is defined as a 50% reduction in revenues for any calendar quarter. So you take a calendar quarter revenues for 2020, compare that back to that same calendar quarter for 2019, and if your revenues are 50% or more lower than they were in that same time frame in 2019, you would have a period of significant decline. And it's important to note that, we'll talk about it on the next slide, that you are eligible in the period where you have that 50% decline, but that only begins the time period, and we'll talk about how that works. For 2021, another enhancement of the credit, allowing more employers to be eligible. Same full or partial suspension of operations, that rule still applies. So if you meet that operation, you think, like restaurants and hotels that are still limited in capacity and limited in their ability to fully operate, they would still meet this even into 2021. Many other businesses are probably back to being able to operate at almost a full capacity, would have to meet the significant decline in gross receipts test in order to qualify. However, a little bit more lenient, the significant decline, you only have to have a 20% decline in gross receipts compared to, so for this, it's 2021 compared to 2019. So you don't go back to 2020, you can go back to 2019, same calendar quarter. So for the first quarter of 2021, you would compare that to the first quarter of 2019. And if your revenues are more than 20% lower than that 2019 period, you would qualify for that quarter. And interesting with the 2021, a slight change, you can use the quarter preceding the eligible quarter. So for example, you're looking to be eligible for the first quarter of 2021. If you experienced a 20% reduction in revenue in the fourth quarter of 2020, you would automatically qualify for the first quarter of 2021. So the same rule applies for each successive quarter of 2021. So if you qualified in the first quarter with that 20% revenue reduction, you would automatically qualify in the second quarter. So in some circumstances, you might have a 20% reduction in the first quarter, might be back to normal in the second quarter. If you have another reduction of 20% in the third quarter, that would get you all 4 quarters of 2021. So you qualify in the first quarter based on the revenue reduction, you qualify in the second quarter because you can use the first quarter, qualify in the third quarter because of the 20% reduction, and then same in the fourth quarter. So you don't have to have that 20% reduction in all 4 quarters. You can use the preceding quarter as your baseline test. And then the American Rescue Plan added a new provision for eligible employers, and this applies only for the third quarter and the fourth quarter of 2021. But if you have a recovery startup business, which would be any business that was started after February 15th of 2020, so after the CARES Act was put into place, after February 15th, 2020, and your average annual revenues are less than $1 million, you don't have to meet either of those first 2 tests. You automatically qualify, and you can get up to a maximum credit of $50,000 if you're a recovery startup business. So a new eligible employer, and again, that only applies to the last 2 quarters of 2021. Pause there if there's any questions coming through the chat.
Not yet, Nick.
Well, we might see some more as we get into the definition of what a full or partial suspension of business is, because this applies to many different businesses in different capacities, and we could see this on a different level for almost all businesses that had a partial shutdown. So it's pretty easy to define if you've got a a full shutdown. If you're a non-essential, you were deemed a non-essential business, especially here in New York, during when we were at people were required to stay at home, couldn't come to work. A few specific, non-essential businesses were required to shut down. Doesn't have to be by a government order, but it's pretty clearly defined. If you've got a period where your business wasn't open and wasn't allowed to be open because of a government order, then you would meet this test. You have a full suspension or a partial suspension. Where it gets a little bit more tricky is when we've got essential businesses that are still operating, still allowed to operate, but may not be able to operate in a full capacity. So you see some of the examples on this slide. It's got to be a government order. It can't be a recommendation based on, if the governor comes out in one of his press conferences and says, I think everybody should stay home for 2 weeks. It has to be a written decree, or you have to have written support and documentation for the government requirement. So like I said, a forced closure of non-essential businesses pretty clearly would meet the definition of a full or partial suspension of business. A shelter-in-place order, if you've got employees that can't come to work because they're required to stay home, you've probably got a full or partial shutdown of business. Curfews on residents that impacts your hours of operation. People have to be home by 10 o'clock, and you have an overnight shift. You're a manufacturer that has a third shift that typically works overnight. They can't come in to work because they're required by the government to stay home during a certain time frame. You have a partial suspension of your business. And then if you have along those same lines, if you're required to close the office or close the manufacturing facility overnight for mandatory cleaning and disinfecting, and typically you would have people working and on the production line during that time frame, you've got a shutdown. Like I said, where it gets a little bit more tricky is when we've got a partial suspension of an essential business. So you could have an essential business that has a non-essential business line, and if the portion that is shut down, if you have a non-essential portion, is more than nominal, as outlined by the IRS notice that I mentioned before. They said if it's more than a nominal portion of your business is affected and required as a shutdown, then you have a partial shutdown. They did give us a little bit of guidance in what that would mean. And you have to look back to 2019, if that portion of your business represents at least 10% either of the revenues or of the employee hours. So 10% is kind of the baseline. So if you have, I mentioned, if you've got a time period where employees couldn't work overnight, that's a more than nominal portion of your business. If you've got 3 shifts and one of your shifts is required to stay home and you can't work during that time frame, your employee hours are going to go down. That represents more than 10% of your employee hours. So that 10% is kind of the threshold the IRS has thrown out there for a partial suspension of business. What if you're an essential business and you rely on other non-essential businesses that are shut down? So some of the examples in the IRS guidance says that if you've got a supply chain interruption, so if you're a manufacturer and you've got a supplier that is providing you with critical raw materials and they're not able to operate to their full capacity, you as the manufacturer, because you cannot procure all of your raw materials timely and cannot produce for final product, you have a supply chain interruption and you have a partial suspension of business. So you would meet the first test for becoming an eligible employer during that time frame where you have a partial shutdown. A couple examples of what the IRS has deemed is not a partial suspension. If you have customers that are required to stay home, but you can still operate, then you do not have a partial suspension of business. Even if you're You can't get, if you have a store operation and customers can't come to you because they're required to stay home, that was not deemed, that's not going to be deemed to be a partial suspension of your business. If you have office closure, but you can continue to operate in the same capacity, you have a less than nominal adjustment to your business. Similar, kind of like in our situation where we've got a lot of folks still working remotely. They're able to do their full job responsibilities at home. So that would not be considered a partial suspension, even though there was a period of time where the office was closed. People could not come into the office to get the work done. If the work can be done remotely, then you're deemed not to have a partial suspension of your business. However, like I said before, if you've got a reduction of your operating hours, and again, all of these have to be as the result of a government order or decree. If you've got a reduction of your operating hours, then you've got a partial suspension. If you have multiple locations, and one location, 5 locations and one location is in a locality that had a government order requiring a shutdown, you're deemed to have a partial shutdown, even if the other 4 are allowed to remain open and operate fully. And if you've got an aggregated group, so similar to that multiple location, if you've got multiple lines of business and one business is non-essential and is required to shut down, you're deemed as an aggregated group that the whole business, the whole group is deemed to have a partial suspension of operations, as long as that piece is more than a nominal portion of the aggregated group's full business. I think I saw a couple of questions pop up in the
Yep. Yes, you did. Actually, Julie was wondering, what about salespeople that couldn't work?
Yeah, so if you've got a partial suspension of their hours, so because we've got a more baseline test in regard to that, if your employee hours are reduced because they can't go and they can't visit potential customers and they're not operating at their full capacity, if your employee hours working are represent 10% and they're not able to work in their capacity, then I think you'd have a partial suspension of business there.
Okay, thank you, Nick. That was our first question right now in the chat.
Very good. So that's the first test of being an eligible employer is you'd have a partial or full suspension of your business. You are an eligible employer during the period when you have that full or partial suspension. The second test is an either or situation. So if you didn't meet the full or partial suspension, you can meet the significant decline in gross receipts test and become an eligible employer for those eligible quarters. We'll see the rules are different slightly for 2020 than they are for the 2021 version of the credit. So for 2021, your period of significant decline begins in the quarter where you have a 50% revenue reduction. So again, same calendar quarter 2020, compare that to the calendar quarter for 2019. If the reduction of revenues is more than 50%, then you have a period of significant decline, and that entire quarter is a qualified quarter. And your period of significant decline ends at the end of the quarter when your revenues are restored to a more than 80% restoration of the prior year calendar quarter. So how that works. So you've got a more than 50% revenue reduction. So call that the second quarter of 2020. You have a 60% revenue reduction. That's your first quarter where you're qualified. If you get to the third quarter and you have a revenue reduction of 30%, you're still qualified. Even though you don't meet the 50% test, you're still in a period of significant decline because you haven't gone back below a 20% revenue reduction. So this third quarter would qualify. Now, when we get to the fourth quarter and you have a revenue reduction of 10%, that's the final quarter in which your period of significant decline would be open. So in that scenario, 50%, 60%, 30%, 10%, you qualify for the entire period, April 1st through December 31st, and wages paid during that period would be eligible wages. So kind of interesting how that works. So you're automatically, if you qualify with one quarter, you're automatically qualified for at least 2 full quarters, is the way that ends up working out. And then 2021, I did mention this earlier, but a 20% revenue reduction, and you can use the preceding quarter revenues to determine if you qualify for the current quarter. So right now we're in the first quarter of 2020. You could have used the baseline test for using the fourth quarter revenues to qualify in the first quarter. And same applies for each successive quarter in 2021.
And we do have some questions, Nick, if you'd like to take them, please.
Sure.
Jay asked, are 501c3 tax exempt nonprofits eligible?
Yes. Yep. So nonprofits are eligible. They actually opened it up to more. It was strictly 501c3s, but the American Rescue Plan opened it up to more nonprofit organizations under different 501c categories. Those are only eligible for the third and the fourth quarter, but 501c3s are eligible in 2020 and all of 2021.
Thank you. And Tony asks, roofing contractor, 1 week complete shutdown, then only allowed to do essential roofs, schools, hospitals. Do we qualify?
Yeah, so I think in that scenario, you're looking at the partial suspension rules, and you have to look to how much of the other non-essential piece does it exceed that nominal percentage. Was the revenues from non-essential roofing more than 10% during 2019? Did that represent more than a nominal piece, which is defined now as 10% of the business? So if it did, then you'd have a partial shutdown because you are no longer being able to perform those services.
Okay, thank you.
Okay. So what are qualified wages? So you've determined that you're an eligible employer and you've got your time frame. So either your period of shutdown or your period of significant decline, you know the period that you have eligible, that you're an eligible employer, what wages during those periods qualify. So for 2020, if you're a large employer, during those periods that you're an eligible employer, only wages that were paid to employees that are not performing services are eligible. So large employers, and for 2021, that's employers over 100 employees. And we do have to look to aggregated groups as for determining how many employees and if you're a large employer. So if you have over 100 employees, even if you're an eligible employer, wages only qualify if you paid wages to those employees not performing services. Basically, if you paid them to stay home and they weren't working during that period of time, then you would qualify, those wages would qualify. However, for those employees under 100, or those employers under 100 employees, small employers, all wages paid during the period that you're an eligible employer are deemed to qualify as wages for purposes of determining the 50% credit on those wages. In 2021, a little bit more lenient in regards to same large employer rules, but the definition of a large employer is increased to those with 500 employees. So, but still, if you're over 500 employees on an aggregated basis, only wages paid to employees not performing services would qualify. And again, same rule for small employers. Wages in a small employer obviously now includes up to 500 employees, wages during those qualifying periods. And the American Rescue Plan added these severely financially distressed employers. And what that means is for the third and the fourth quarters, even large employers that did not qualify prior or had a qualifying period but didn't pay anybody to not work, they were only paying employees that were performing services. If they're severely financially distressed, and that means a decline in revenues of 90% during that quarter. Again, I think to restaurants and hotels, some of those larger hotel groups or restaurants that have, a chain of restaurants that, but they can't have more than 20 separate locations. I think to those that may be severely financially distressed, even if they have more than 500 employees, all wages would qualify if they meet that 90% revenue reduction test. And that was added with the American Rescue Plan last week. So the key to look at here, and we've got some additional guidance the beginning of March in regard to how do we coordinate the wages. So you cannot use the same wages that were forgiven under the PPP program that in order to utilize, you can't utilize those same wages and take the credit. So if you've got qualified wages for the employee retention credit, you have to look to, did those same wages get forgiven under the PPP program? And this IRS notice 2021-20 kind of walks through some of those calculations and how that works. But we'll want to make sure to be looking at that, especially as we look at PPP round 2. Your eligibility for PPP round 2, if you've applied for that, and if you also qualify for the employee retention credit here in the first quarter of 2021, we'll want to make sure that you utilize wages outside the PPP period to take the credit, and then have the full forgiveness on the PPP wages once you receive the funds. So we'll see kind of how that on a bigger picture, how that calculation works and how the IRS has interpreted how that calculation will work. But that is where I anticipate seeing the majority of some of these complicated calculations, because you've got to do it on an employee by employee basis. So you'll have to do some coordination with trying to make sure we can try and maximize the employee retention credit while also ensuring that you will achieve full forgiveness when you do the application for the PPP. So I put these in kind of order of priority. You'd want to take the PPP loan first. So if you're thinking you've got an either or situation, the PPP loans are fully forgivable, can be up to 100% of the wages that are forgiven. It's non-taxable. So the benefit of the PPP is greater than the credit under the ERC, but now that we can use both, it even enhances the value of the PPP even further. So if you qualify for the PPP, you should apply for the loan, work to get the full forgiveness, and then we'll work on the ERC after that. We've got these sick pay credits, paid leave credits under the FFCRA. So if employees are required to quarantine or they're sick with the coronavirus, they have to stay home for a period of time and you're required to pay them for the 2-week period, then there's a full 100% reimbursed credit for that payroll tax credit. So obviously that would take priority over the ERC. But again, you cannot use the same wages that are reimbursed for the FFCRA credits and use those wages again and receive an ERC credit, an employee retention credit. But because it's 100% reimbursed amount, that takes priority over the ERC. But the ERC, after you've used your wages for the PPP, you've used your wages for the sick pay credits, the ERC will enhance and provide an additional benefit on additional wages that are paid. So that comes in third priority. And then you do have to reduce any other credits that are wage-based. So there's a number of employer income tax credits that are based on wages, your R&D credit, and empowerment zone wage credits, work opportunity credits. So there's a number of employer-based income tax credits that would come after the ERC, and you have to reduce the wages that are used to determine those credits by the amount of the ERC that's received.
Okay, we do have a question for you, Nick.
Okay.
In relation to the ERC, this is from Tricia Lutz, ERC, and in relation to the ERC and provider relief funds, how do we account for provider relief fund income we received in March of 2021? Eligibility will be a challenge in 2021, 20% reduction in revenue, depending on the accounting treatment of the PRF.
Yeah, so revenues include all sources of income except for those specifically excluded, which is the PPP forgiveness. So if you have PPP forgiveness, that's not included in your revenues. However, other sources of revenues, grant income that would typically be included in revenue, does have to be included. So revenues, interest, dividends, other sources of income are all includable in your revenues. The only thing that's specifically excluded would be the PPP.
Okay, thank you, Nick.
So I wanted to kind of walk through one example of how the coordination between the PPP and the employee retention credit works. This is right out of the IRS notice, the example that they used. We'll take a look at what happened if you already applied under the first round of PPP. You already applied, received your forgiveness. Well, how a couple different scenarios and how that application was presented, how those affect how much of your wages have to be allocated to the PPP and can be used, and how much can be used for the ERC. So in this case, the employer received a PPP loan of $200,000. On the application, they paid wages during the PPP period of $200,000. They also had other eligible costs of $70,000. So rent, mortgage, interest, utilities, other operating costs that are now eligible under the PPP program to be forgiven. Those totaled $70,000 for their PPP period. However, they did not report on the application. They didn't put the $70,000 of eligible costs. They just said, they, rather than go through all the paperwork and provide, all my utility bills and have to provide, lease agreements and all of the administrative burden that putting that additional $70,000 on the application would cause. They just put the $200,000 of wages, gave the payroll support, easy, sort of backup to pull, and they get the full forgiveness. Now we're looking, we can't use the PPP wages. We could have put $130,000 of wages rather than the 200. How much of my, can I use that additional $70,000 of wages and claim the ERC instead? And the IRS is saying right now, no, because they didn't put the additional $70,000 on the application. They must have allocated $200,000, the full forgiveness, to wages. So those $200,000 are PPP wages and cannot be used for the employee retention credit. And the next slide kind of goes through an example. If you put that $70,000 on the application, then the answer is yes, you can reduce those wages, those PPP wages, down to $130,000. So you could reallocate and recalculate and get the ERC on that additional $70,000 in wages in that scenario. So I know that there is some letters coming from our organization, the AICPA, the American Institute of CPAs, to see if we can get that adjusted, because it seems that the same employer in that scenario is treated differently just based on the application that they've provided. There's no change in the circumstances. It's just a matter of the formality of filing the application. So just a note of caution if you haven't filed your application for the first round yet, make sure to include all of the additional costs that are eligible. And as we look to round 2, when we're going to be doing the applications for the PPP for round 2, make sure to include all of those other eligible costs that you can, to minimize the amount that's forgiven as payroll. The more we can get out of the PPP wage bucket, the more we can look to claim on the employee retention credit side.
Nick, we do have a question if you don't mind taking one right now.
Absolutely.
What was I? From Julie, the application is the forgiveness or the application for the PPP?
The application is on the forgiveness. So the forgiveness application in which you applied and received the forgiveness. So you have to include those other costs now on any that we're doing on a go-forward basis.
Okay, and Tim is asking for small loans where you just needed to certify and not provide payroll dollars or other cost dollars. Do you have that opportunity to maximize ERC wages using the other eligible costs?
Yes, because you didn't have to provide the operating costs, the additional operating costs. So you didn't submit an application with just wages on it. You submitted an application that said you spent all of the funds on allowable expenses. So you would be able to support the fact that you had those additional costs that would have qualified.
Okay, great. Thank you, Nick. Oh, wait, I have one more.
One more. I just saw it pop up.
PPP period was 24 weeks of payroll if you spent more on payroll than the loan in those 24 weeks. Is that qualifying wages?
So yeah, so in that circumstance, even if you put on the application that you had 300,000 in wages and your loan forgiveness amount is 200,000, you are allowed to reduce the wages to the 200,000. So it maxes out at the amount that's forgiven.
Okay.
So even if you put on the application more wages than the loan itself, you can reduce it for that.
Okay, thank you.
Yep. Okay, and then, so no more questions on that piece, the coordination with PPP. We'll get to the most important part, which is how do you get the credit? How do you claim the credit? How do you get the money? So for 2020, these are all done through payroll taxes. So you'd have to amend your Form 941. The IRS did give a little bit of relief in regard to this. If you're qualified in the second, third, and fourth quarters of 2020, you can file just one amended return. You can do just the fourth quarter. You can claim the full credit in just the fourth quarter with your fourth quarter 941. And you'll want to make sure to coordinate this with CPA and also with the payroll providers, because they'll be the ones that will be submitting the ultimate payroll forms. So that's option number one, is to go back. If we've got eligibility in prior quarters, go back and file an amended 941 and ask for the refund. And then for periods going forward, so for the first quarter of 2021, you can claim the credit on Form 941 when you file it here in April. So you would claim the credit, and the amount of the credit that exceeds the tax that you paid and remitted would come back as a refund. So you can claim the refund with a current period 941. And then the third option, which is a really good option, is on a go-forward basis, reduce your payroll tax deposits. If you anticipate that you qualify for the credit, or if you meet the test because you qualified in the preceding quarter and you know you could qualify for the current quarter, you can reduce the amount that you're paying on a regular basis, depositing with your payroll taxes. You don't have to pay the money to the IRS up front. You can hold on to that, and then when you file your 941, obviously bring the records for the determination of the amount of the credit, and then you would just reduce the tax that you have on deposit. And then the fourth option there is if you reduce your deposits and the amount of the credit you anticipate is going to be even more than the taxes that you would have had to deposit, and you're due a refund, which will be the case in many instances because 70% of the wages is more than the amount of the taxes that you have to remit. So you can request an advance credit before you file your 941 on this new Form 7200. So multiple ways to claim the credit and get the credit. I think the best one is to reduce the payroll tax deposits rather than ask for the money back later. But those are all your options to receive the benefit of this credit.
All right, and we have another question from Carrie. So you claim the credit, get a refund back that is counted as other income, which then becomes taxable as business income?
So yes, you actually have to reduce the deduction you receive for the wages. So by way of reducing the deduction, it is taxable income, which again is why I said that this is kind of secondary in priority to the PPP. PPP is fully forgivable and not taxable. This would come back as a reduction of your wages deduction and would essentially be taxable income. So that is important to consider.
Okay, thank you, Nick.
So we'll shift gears a little bit. We'll talk about some of the other provisions that are in the American Rescue Plan that was passed last week and signed into law. Some of the business, again, more on the payroll side. So an employer can provide dependent care assistance. They've increased the amount that comes out pre-tax there. So the exclusion goes from 5,000 up to 10,500 for dependent care assistance that would not be taxable to the employee. So you can look to either adjust your plans in regard to this or provide that additional benefit option to your employees. The credits for the paid sick and family leave, so they extended these through September 30th, so a nice benefit there. And then so they've extended that through the 30th. There's also additional options for additional funding, additional grants that are available now under the American Rescue Plan. One is for restaurants, so pandemic assistance grants that are specifically geared to provide assistance to restaurants that have experienced a revenue loss related to the pandemic. So some of these new incentives are a bit more targeted towards certain industries, and the restaurants being one of them. I mentioned this before. Somebody asked about nonprofits being eligible for the PPP program. There are more is available to more than just the 501c3 organizations. And for certain nonprofits, the employee level is up to 500 instead of the 300 for PPP2. In addition to more nonprofits, they've opened it up to eligible businesses under internet publishing organizations. So a specific NAICS code for those. They were previously not eligible. Now they're eligible under the American Rescue Plan. They can go, if they meet the other requirements, they can go for a PPP. This, as of this morning, may be outdated. The due date is still March 31st. There was a bill passed the House this morning, fairly overwhelmingly, that they would push the deadline for applications of the PPP off to May 31st. So we'll keep an eye on where that goes. As it stands right now, it is still March 31st, but there is a bill that has passed the House, and it was 400 and something to 3. So there were only 3 against it. So it seems like that's getting some push to be extended. The application deadline for PPP round 2 looks like it's going to be May 31st instead of March 31st. And there's the targeted EIDL advance, the economic injury disaster loans. These were the up to the $10,000 grant from the SBA for those affected by the pandemic. There's a more targeted version now, basically another round of EIDL grants advances for businesses located in low-income communities and businesses that incurred a more than 30% revenue reduction. So a more targeted, like I said, they're looking to find out who was more significantly affected by the pandemic and get them some funding through grants through the SBA.
We have a question.
Okay.
Is EIDL forgivable?
The EIDL, this targeted advance is a grant. So it's up to the $10,000. So it's based on the number of employees, $1,000 per employee, up to $10,000. And that is a grant that is a forgivable grant. It's not taxable income, and it does not have to be paid back.
Great, thank you. Another question. I had read that the EIDL was only for ED zones or anywhere.
So the initial one was anywhere. This one's a more targeted one. So it is low income areas, which would be those ED zones. So it's the more targeted areas, the low income communities. So it's businesses that are located in those communities.
Okay, and another question. Nick, you said that the FFCRA credit is 100% credit for wages paid. My payroll processor does not calculate 100% wage credit if the employee is out for the entire pay period versus working one day during a pay period and getting 100% reimbursement for partial absence. Have you heard of any prorating of the FFCRA credit amount like this?
Well, so it would be during the period where they're required to, and they're not working. They're required under quarantine to be home, and can't work. So if you're paying them it's up to the $510, $511 per week, then that's the piece that is fully reimbursed. So if you're paying them and they're working, you don't necessarily get the FFCRA credit. It's only the wages that are required to be paid under the FFCRA program.
Okay, thank you, Nick.
Yep. Okay, we'll kind of quickly go through some of the individual tax provisions that are in the American Rescue Plan. We've all heard about the economic impact payments. Supposedly those are already being deposited into accounts, but it's an additional $1,400 per taxpayer and per spouse and dependent, and those have phase out limitations. It's $75,000 and fully phased out at $80,000 of adjusted gross income, and then that doubles for a married filing joint couple. It goes to $150 to $160 for a married filing joint couple. Some significant changes and some complications with the child tax credit. So this has increased from $2,000 to $3,000. There's a additional $1,000 child tax credit that's available to lower income taxpayers. You can see the thresholds there on the slide: 75,000 single, 112,500 at a household, and 150 married filing joint. Anybody under those would qualify for this additional $1,000 per child. And if the child is under 6 years old, there's an additional kicker of $600. The complication is that the IRS has to come up with a plan to make advance payments starting July 1st based on whether they think you're going to qualify in 2021. So they have to determine how much you will qualify for 2021. And presumably this will be based on either your 2019 return or your 2020 return. And then 50% of the credit that you'll be eligible for will be paid out in monthly advance payments beginning in July, from July 1st through the end of the year. So some complications there that the IRS is going to have to work through to get everybody 6 monthly installments of their advanced child tax credit. So we'll have to keep an eye on that one, but pretty complicated calculations and who qualifies and when do they get the payments. And if you get more than when you get to your 2021 return and you determine you weren't eligible for as much as you received, you do have to pay back the difference. So different than the way the economic impact payments work. If you come to your next return and you didn't qualify, you do not have to pay back the economic impact payments. You do have to pay back any excess child tax credit that you receive in advance. So that'll create some complications for the IRS and with the forms that we see for 2021.
We do have a question for you.
Sure.
My son turned 17 last December and we only received a $500 credit. He will be 18 and I will lose out both 2020 and 2021, correct?
That's correct. It's only children under the age of 17. Yep. That would qualify for this advanced $1,000 credit.
Okay, thank you.
There's additional earned income tax credits. It's increased availability for those that don't have children. So there's an increased availability of that credit. So they've added that. In the child and dependent care credits, now that was $3,000 per child. It's up to potentially $4,000, and the rates have increased. It was 30% of the qualified expenses. Now it's 50% of qualified expenses, up to that $4,000. And an additional increase to the amount of the premium tax credit. So if you're in a low income bracket and paid health premiums, you would qualify for a potential health care premium tax credit, and the amounts of those credits have increased. And then the final one I've got here today is the unemployment compensation under the American Rescue Plan. So they've extended the federal pandemic unemployment eligibility. That's $300. That's extended out. It was scheduled to, I believe, end this week. And now it's extended out through September 6th. And in addition to that, the first $10,200 of that income, previously under old rules, that would have been a taxable income to the recipient. The first $10,200 now is not taxable. So that raises a few questions. What if you have unemployment compensation and you already filed your return? How do you go back and reduce your taxable income by the $10,200? The IRS has said, do not file an amended return yet. Don't do that. We don't want all these amended returns. We're going to figure out a plan on how to get you guys compensated. And in the meantime, they're also working on a worksheet for those that have unemployment compensation that haven't filed their returns yet, and how to report that. So IRS is still working through that and going to provide guidance, hopefully pretty timely here, so that we can get some returns filed in the next couple weeks. And then the other question that comes about is what's New York State going to do with that? As of right now, they follow the federal adjusted gross income, except with the exception of certain items that have to be adjusted. So as it stands right now, unemployment compensation would be reduced by the $10,200 for your federal AGI, and that's your starting point in New York. So unless we hear that they officially decouple from that treatment and provide an add back, currently we will see that New York State income doesn't include that $10,200 either. But again, we'll be on hold until we hear something from the state on that. And that is it. 2 minutes over. I think we
Okay,
started 2 minutes late, so I think I did okay.
that's perfect. That's perfect. Here's another question for you. Right now, should we fill out unemployment compensation taxable before IRS has a form?
So they have released some guidance, but they're working on a worksheet that's going to be available. Right now, you put it on Schedule 1, Line 8 as a negative number. So you put, but the worksheet is going to determine who is eligible and how you calculate that amount. So they're working on that, and they're going to be providing that to software companies to have it integrated into the software. So they're kind of telling taxpayers to take a wait and see approach. Don't rush to file the returns. Let's get this all figured out first, and then we'll do it. But there is you can put it on Schedule 1 as a reduction.
And this is a great question, Nick. Yes, to all our attendees, we will be sending you not only the recording, but the slides later today. So yes, thank you, Tony, for that question and for reminding me to mention that to everybody. So if there are no further questions, Nick, thank you so very much for this incredibly informative webinar, and a huge thank you to Dannible and McKee. This was very important for all of us, and we just appreciate your time. And we appreciate all of you for attending and asking such great questions too. So thank you. And like I said, you'll be getting the recording and the slides later on today. We'll be sending that to all of you. So again, big thank you, Nick. And thank you so much, Dannible and McKee. This was terrific.
Absolutely.
Thank you.
Thank you guys for the opportunity, and thanks everybody for joining, and I appreciate it. And now we can go and celebrate St. Patrick's Day
Great.
with all that wealth of information.
Happy St. Patrick's Day, everybody. Thank you.